All right, so finally we have our LIFO that we want to establish. And once again, we're making this entry at 131, not on the day of sale. Make sure you understand the difference. I like to see students succeed and not give me the wrong entries on cost, on an inventory question. Um, Same piece. We want our purchase discounts gone as debits. We want our purchase returns gone. Our purchases, our freight, right? All of those still at the same amounts because our choice of cost flow method does not alter our purchase accounting, right? Our beginning inventory also has not changed. We're still getting rid of that balance, $1,400. Now we just need to assign a cost to the ending inventory that we counted and then back into cost of goods sold as a plug to balance our journal entry or solve the inventory equation, whichever way you want to approach that. So the 460 units. Now remember, we are using LIFO, which means we assume that we sold the oldest inventory first. And because we're doing periodic, we're considering all of the sales at once, right? We're acting as if I sold 1,500 units all at 131, basically. And then going back from there. This is my most recent purchase at 131 to assign cost of goods sold. So these would have been sold, these would have been sold, right? So we're selling the ones at the bottom, which means that our ending inventory, the things that are going to remain are going to be at the top. So we're going to have this 200 units at 7 still remaining. Right? But we need 460. So then we go to these 260 of these to get to 460 in total are going to need to be sold. And then we have our 260 at 834 per. Oops. Do that calculation. And that's 2,168 and 40 cents. So my total ending inventory, 3,568.40 would be this amount here. And just check that math one more time because I did it by hand. Right. All right. So now we need to back into cost of goods sold. Um, you can establish the equivalency of debits and credits and get the plug. But as I mentioned, the other way to do this is to determine goods available for sale, which we have done, right? We already know that's 17,156.10. And understand that the other side of this goods available for sale equation, once we have goods available for sale, is if we subtract our ending inventory, what is the result? Cost of goods sold. So this inventory equation to me and how I structure my thought process in working through these problems, so important. Right? It makes a lot more sense and adds to your overall understanding much better than just doing a plug. We have our goods available for sale, 17,156.10. We're going to subtract off the ending inventory of 3,568.40. And this will give me the cost of goods sold that would plug. $13,587.70. Right. So that's my cost of goods sold for the period, all recorded on the final day as an adjusting entry. And my cost and my ending inventory is 3,568 and 40 cents. So notice that the ending inventory and the cost of goods sold under periodic LIFO is distinct from the perpetual, right? FIFO is the only one that will always line up. If these line up, it's a coincidence. For LIFO, it's a coincidence for average cost, right? So that's the end of the calculation portion of this. And I will have probably one more video just talking about the differences between FIFO and LIFO under, what the advantages and disadvantages of choosing those are. They tend to be the most used. LIFO definitely the most, and FIFO probably second most used inventory cost flow assumption.